Appreciate your time here on CNBC TV18. Vinay Jaising is joining us now, Managing Director, Portfolio Management Services at JM Financial Services. Vinay, really sorry you had to wait a little bit today. So apologies for that. Pharma took over, so we were kind of focusing on that early on. Vinay, just wanted to focus on one sector that you like in the light of earnings that we've got recently. I'm talking about specialty chemicals. We've discussed this previously as well. SRF numbers recently, right, which came out, and generally the drumbeat that one hears is that specialty chemicals perhaps is entering a maybe 6-8 quarter kind of down cycle from here out. Do you agree with that kind of view? And is there anything to do here with these stocks? SRF is a huge underperformer. I think you own Archean in terms of stock from that particular space. What's the call?
So I think you're saying it right. China growth, which was supposed to come, has not happened, as a result of which the inventory management system in China has increased. And you're seeing a lot of pain in the specialty chemical sector. So that's the reason why I think 1 or 2 quarters more, you would see this pain remain. Having said that, what we are buying or what we have in our portfolio are companies like Archean, wherein we are seeing they're the best on the cost curve. Their raw material is literally water, Gulf of Kutch. So the best in terms of gross margins. Second, net cash company of 5%. As far as their market cap is concerned, they have net cash of 5%. Third, very impressive return on capital employed of 25 to 30% already in a market like this. And when the others would find pricing of bromine coming down being a problem, Archean can clearly produce and make profitability. So when the cycle turns around, which could be 1-2 quarters, we think Archean would be the key beneficiary of this cycle. Having said that, we like the bromine chain. It's moving to fire retardants, moving to derivatives shortly. And the company's production norms also are pretty good. The capacity utilization is relatively inching up. So that's one company we like in the specialty space. But yes, there is pain in the next 1 to 2 quarters in the specialty chemical space, courtesy China.
Hi Vinay, good afternoon, good to see you in. Vinay, I wanted to ask you about 2 stocks that have done very, very well. They came out with their numbers earlier this week. That's Tata Motors and KPIT Technologies. Now you have gotten, I think quite some time back, and you have been positive on it. Every time you join the show, you've been talking about a few of these stocks. What's the view? How much of the good news is in the price, both on KPIT Technologies as well as on Tata Motors?
So let's first talk about Tata Motors. Tata Motors did a good action as well, buying off the DVR, cancelling it and converting it into normal shares at a 7:10 ratio. That reduces the overall share count by 4%. If I look at just purely consensus numbers on an EV/EBITDA basis, they're at 4 to 5 times 1 year forward. Most of the other auto companies are at 10 to 12 times forward. People had questions on JLR turnaround, and here the company is already FCF positive. The demand is very robust for JLR, at least for the next 1 to 2 years. You add that with the good domestic work Tata Motors is doing, and probably a listing of Tata Technologies, which would help it as well. So we're pretty excited about it. Yes, the stock has done well, but next year it will be not just FCF positive, but net cash. That should let the stock also do a lot more better in the times to come. So we're excited on it even today. Moving to KPIT, here there are 2 angles to look at it. And the first is US having a slowdown? I think the answer, at least in the services sector, is yes. You've seen Fed raise interest rates once more by 25 bips, and you may get one more for the remaining part of the year. The inverted curve in US also tells us between the 2-year and 10-year chart, which is at minus 100 basis points, that you could see slowdowns in the order book for IT companies. And here there's one company which comes and gives you an order book growth of about $190 to $200 million. If I look at the last 5 quarters since they've been giving the order book and just add that up, it's north of about $2 billion, 2.2 times, the overall size of the overall last year's revenue growth. It's seen a 1-year sequential growth of 8% in revenues and a year-on-year growth of about 45+% in revenues. So you're seeing this company still grow in an environment like this. It got the Honda order last quarter, and it doesn't still have a company like Tesla in its order books. So it's doing well on the EV story. And as the EV story gets a lot more automation involved, I think KPIT will buckle the trend of the IT sector. So very excited out here.
Okay, and KPIT has been, of course, a great wealth creator in the last several months. So I guess it's worked really well for you. Vinay, the other stocks that I think your investors would be very happy with would be some of these railway plays. I think you've got Titagarh Rail within the portfolio. You also have some exposure to interesting defense names like MTAR. I mean, Titagarh Rail, if I was just looking at a one-year chart, just this year it's up 200%. So what a mover. The question is that, are you still convinced that there's more value left on the table, or do you think that do you think this is a play that's kind of pretty much run its course? You ride it till the tide turns. I mean, fundamentally, what's your call on both defense and some of these railway plays?
So if you look at what the Indian government has done on its budget outlay, both in railways and defense, as far as railways are concerned, they've increased it tenfold. So whatever the number is of 2.4 trillion this year, it is 10 times higher than what it was 10 years ago. In defense, that number is about 2.5 times higher than what it was 10 years ago. Talking about railways first, as Vande Bharat project gets bigger and bigger, you're seeing players like Titagarh Railway increase their order book. Today, their order book is 9x their current year's revenues. So you know for sure, in the next 4 to 5 years, the revenue growth is going to be rock solid. We saw the quarterly result which came out of Titagarh. Their top line grew by some 110% and the bottom line tripled. So what EPS numbers are analysts using? This is still not covered, largely by most of the sell side team. So you're seeing an earnings trajectory move up on the EPS front at one end. That leads to a return on capital employed also move up for the company. And the company pretty much does not have much net debt on its books. So it also got invested by a couple of interesting investors in the shorter term. So I think the story is, yes, the stock has become more expensive than what it was earlier. But the story is here to say, yes, it may go a little slower. But as you see more and more contracts coming up for the railway industry, we'll be looking at Titagarh Railways a lot more appealingly. Having said that, the defense front, not a nine times price to book, but Bharat Dynamics and MTAR, both of them have little different stories. Bharat Dynamics is purely defense. It's got an order book of 6+X, and it's also a export story. Today, their exports are 7 to 8%. They are into missiles. Akash is one of their big launches or brands which they have. And the earnings is growing by as much as 50% for this company for the next 2 years. Again, return on capital employed is what we like in north of 23 to 25%. Yes, the PE is no longer 15 to 20. It's moved to the 20 to 25 X band for F25 numbers. But with an earnings trajectory of that, its PEG ratio is half. So we are excited about Bharat Dynamics even today. In the case of MTAR, it's got a little bit of clean energy story and a little bit of defense story. About 65 to 70% of its overall top line comes from exports with a single player Bloom, which is listed globally, which itself is growing pretty fascinatingly, helping MTAR get more and more order book. So the company's top line is again growing at north of 30% and bottom line in the same range. And return on capital employed at about at about 25%. And the P is now inched up to 30. We like it because of its growth. So what you're looking out here is growth at reasonable valuations for both these stocks. Actually, even the railway industry.
Absolutely. All right. We thank you, Vinay, for joining in and giving us that view. But we have big numbers that are coming in.